The views expressed in this podcast are not to be taken as either trading nor financial advice. Neither the announcer nor the Sirius Report make any claims to be certified financial advisors, and all reporting is dedicated solely towards being both informative and educational. Greetings, everyone. Good afternoon. Welcome to the Sirius Report Market Wrap-Up for Friday, November 15th, 2024. Apologize for not having any other market wrap-ups this week. It's actually been busy on the personal front, both with I and Paul having things going on in the personal world, but we were able to get one here today, it appears. And he and I are going to be doing some recording tomorrow, 3 new podcasts, one of them which may even include a look at Bitcoin, Tether, and the US dollar and what's going on with that. So with that in mind, we're going to take a look at some economic data for the week and an interesting little back and forth I had with somebody on X/Twitter in regards to what the difference is between finance and economics and why it's a social science and not a mathematical one. So with that in mind, let's go ahead and jump right in and see how the markets fared. Well, after Trump won the election, of course, the equity markets shot to the moon. The dollar shot up and continues to climb, while also bond yields start to skyrocket, showing that we are inflation. The greed of Wall Street into the equities continues, but that means absolutely nothing to the general economy. The Dow, which had been over 44,000 easily last week, ends this week down 305 points to 43,444, while the Nasdaq was down a whopping 2.24%, down 427 points to 18,680, and the S&P 500 was down 78.55 points, closing out the week at 5870. In the bond markets, the entire yield curve raised higher as we continue to show that inflation is going against what the Fed is trying to push with their 2 rate cuts of 75 basis points over the last 2 cycles. And in fact, this is going to be something that is affecting rents in Manhattan, and one of the things behind my discussion on X regarding economics and finance. The 10-year was up 0.025, closing out the week at 4.445%, while the 20-year now is over 4.7% yield, the 30-year over 4.6%, and the two-year continues to invert with the 10-year. It's closed out the week at 4.307. In the dollar markets, well, last week when Trump won the election, the dollar was sitting just above 104. Now, about a week and a half later, it closes out on the DXY at 106.76, up 9 cents today. This is, of course, against a primarily European and the Japanese yen currencies, and really doesn't show any what's really mattering when it comes to China, Russia, India, the Middle East, West Asia, etc. This is simply showing that European currencies are, and especially the euro, are declining rapidly, much more rapidly, with the expectation of Trump coming in with his tariff policies. In the gold markets, well, gold continues to get spanked down as short covering is the call for the day. Silver was down 21 cents, closing out the week at $30.29, while gold was down $3.80, closing out at $25.61. Now, it was due for a pullback for sure, but more often than not, we're seeing it still climb in Asia at these lower prices and lower premiums, or I should say duties, especially in India, are selling out the physical gangbusters. But the Wall Street is still madly stuck with so many naked shorts contracts in the COMEX that it's likely they're going to slap down the prices continuously going into at least the end of November. In the crypto markets, Bitcoin had another recovering day, not quite a new all-time high, but pretty close. Bitcoin for the last 24 hours is up 4.46%, closing out this session at 91,219. Ethereum, meanwhile, was up 0.69%, closing out at 3,081. Now, the importance that we're going to take a look at is Bitcoin has been moving in tandem to the NASDAQ, and the NASDAQ has been absolutely screaming on bubble territory. But something else is sort of the middleman between this. The big boost from Bitcoin over the last 3 weeks from the 70,000 range up over 90,000 has been the cryptocurrency known as Tether. And we're going to look more into the dollar Tether Bitcoin tandem tomorrow or on Sunday, Monday, when we put out the podcast, when Paul and I discuss it, and the fact that Bitcoin is not going up because retail investors are buying it. It's going up because it's being pushed on the derivative markets by those who are tied to Tether, tied to the dollar, and even the Treasury is involved in this. In the oil markets, oil continues to go down as the global recession continues to spike. WTI crude closed out the trading day down $1.68 and the week at 67.02, while Brent crude was down $1.47, closing out at 71.09. Now, interesting thing. New York business loves Trump, but U.S. manufacturing still contracted in October. The Empire State Fed Manufacturing Survey of General Business Conditions exploded higher in November. The headline General Business Conditions shot up 43 points to 31.2. It had been in the red the previous month, and it's the highest rating in nearly 3 years. This is the second largest month-over-month jump in the survey sentiment in history, and the manufacturing activity grew strongly in New York State in November, with firms reporting sharp increases in new orders and shipments. Price increases remained steady and modest, while firms remained optimistic about future conditions. That's the key thing, future conditions. Wall Street is happy that Trump is now in office. But while New York businesses seem to love this, U.S. industrial production as a whole declined 0.3% month over month, second month in a row, and the third out of the last four that has been in decline. And it was even revised for September. So there is New York, which is Wall Street, and then there is the rest of the country, which is not buying into the hype. Taking a look at a U.S. retail sales control group, this is something from Bank of America that they did some research on. The retail sales unexpectedly tumbled in October after a huge seasonal adjustment. Well, why was this? It's because the Democrats lost and the administration is no longer fudging the numbers. So now they're going to start making huge seasonal adjustments and revisions to try to make things look worse as they transition over to the next administration. If the omniscient chaps at B of A are right, the soft landing narrative is about to crash, as they forecast a well below consensus tumble in retail sales. The expectation is that retail sales will come in at minus 0.4%, an absolute shocking decline. Notably, this is mainly due to seasonals, however. Seasonal adjustments are likely to impact the October retail sales report. And the consensus, of course, is that it's going to be considerably less favorable. So this is the expectation going into, of course, November being the start Black Friday and to the Christmas holiday shopping season. Well, there's some interesting things we're going to take a look at from the most important news blog. Consumers are drowning in debt as hordes of businesses fail all over the U.S. We're going to take a look at some of the numbers here. Collectively, credit card debt has now surged to a new high of $1.17 trillion. Credit card balances rose by $24 billion in the third quarter, and as people are continuing to have to use their credit card just to buy sustainable goods, as inflation has maybe gone down in the scope, but it's not gone down in prices. We also have with 30% of all student loan borrowers have gone without food or medicine due to their monthly bills. In addition to skipping necessities, 38% of people with federal student loans said they carried credit card debt they wouldn't have otherwise. Now, I brought this up before, and I don't know if I mentioned it in Market Wrap-Up since we put things out on the YouTube channel. But the reality is that the government should not simply wipe away student debt. This is something that young people, 18, 19, 20, 21, whatever, they signed a contract and they are legally bound to the contract. And to simply wipe it away would be to pretty much put all contract law into a gray area where we would no longer have a standard. The one thing that is necessary, though, is hopefully the Trump administration looks into it, Congress looks into it, somebody looks into it, is going back and revising the bankruptcy laws, which allow student loans to be eliminated in a bankruptcy. Now, the reason this is important is that a lot of the younger generation is going to be the expected ones to buy equities, to pay for Social Security, to buy the homes, to generate the income to keep the economy going. And if they're already massively in debt, then they're going to have no way out to do this. Having a bankruptcy, of course, will give them at least a modicum slap on the wrist. They're going to have to take their medicine as type of punishment, but it will allow them to get out from under this and start rebuilding. That's what bankruptcy is for. The problem is going back a few administrations, the United States government should have never, ever gotten into the underwriting of student loans. This, of course, left the university sector to go ahead and have massive amounts of liquidity that they use to build up their fiefdoms, their endowments, their administrations, and raise and skyrocket the cost of tuition. Well, as more and more people have discovered, a college education, especially in the U.S. education system, isn't worth the paper that it's printed on. So what needs to be done is that the U.S. government needs to get out of the student loan business as well as much of education, and allow competition to come in. The other thing that needs to be done is I think we need to get rid of this idea that education is an untouchable rail. The fact of the matter is that at the college university level, people are paying for a service. They have an expectation that they're going to get a specific product or outcome for their money. And if they don't, then they should be able to demand their money back as a refund, or they should be able to sue for negligence and the liability of that. That would hold colleges to then perhaps get rid of some of their wasted education level talent, as well as their administrations, if suddenly they had to treat education as a business and provide the service accordingly. And of course, China and India are blowing away the U.S. when it comes to creating engineers, innovation, technology, and we just can't afford to have the continued illiteracy that we have under the current education system and collegiate system. Moving forward, well, we're taking a look at what the Trump system for finance and economics is going to be, primarily economics. And at least on the outskirts, we're talking about a return to what is known as the American system. Now, the American system was something that was invented back in 1790 by Alexander Hamilton and supported by Washington, John Quincy Adams, Abraham Lincoln, and the like. The American system focuses on 4 specific policies. High tariffs to support manufacturing high-paying jobs, but not tariffs when it comes to agriculture and services. Infrastructure investment, public and private, to support productivity. That's how the Erie Canal was built. It wasn't built by government funds. It was built by private investment. A strong Army and Navy to protect the U.S., but not to fight foreign wars. And if we got rid of most of the bases and we stopped interfering with most of the rest of the world, we could probably cut the $8 to $900 billion budget down to about 245. If you think about it, Russia is able to conduct a war and have better technology at just a military budget of $64 billion. And their nation is much bigger than the United States is. The other is a central bank with limited powers to provide liquidity to commerce. Not liquidity like it's done to the banks and Wall Street under financialization, but liquidity to commerce, small businesses and business in local areas trying to build up infrastructure and the like. This, of course, was the American system, and it worked from 1790 to 1962 with different disruptions, such as with the Civil War and the changeover from agrarian to more of the urban center. In 1900, we were right about the point of 50-50. 50% of the population lived in the rural, 50% of the population lived in urban centers. Then, of course, we had the big immigration from 1900 to 1920. We had the war effort. And then, of course, after World War II, where majority of people were in the urbans, we created something called the suburbs. People had access to get to their jobs in the city, but we created a highway system that allowed them to live outside. And of course, you see this in New York, where many of the wealthier people live in Connecticut, and they can just take Amtrak or some other train to get to New York City, Manhattan, and the like. They don't have to live where the prices are too high. So with that being said, this is what they're going to attempt to return to. Well, this is in 1790, and of course we know that there is a multipolar world out there that is not going to be willing to function under a form of tariff system that the U.S. is trying to implement. So it will be interesting if parts of that system are going to be able to work, parts of it are not. But guess what? The big difference is between 1790 and 1962, we had a silver standard. And it worked under a silver standard. Post 1964 and then later 1971, our fiat currency was no longer based upon any type of resource. It was completely fiat, and money expansion, currency expansion, I want to say, was done to the nth degree, where now we are absolutely broke and bankrupt. Well, the dismal task of the economist. As I mentioned, I got into a nice little discussion with somebody on X regarding economics and finance. And one of the most important things is the difference is that economics is really not best done by getting a degree in economics, but more in getting a degree in social studies, psychology, primarily behavioral psychology, history, and social studies. Why? Because economics is a social science. It's looking at how policies affect local, state, federal, global communities based on those things. As I mentioned, the tariff. How does the tariff affect farmers? How does it affect chip corporations, chip making corporations? How does it affect trade and commerce? Those are the things that really economics is about. It's not about the finance. It's not about whether the Fed drops interest rates or the like. Those have minor things when it comes to economics. And I was reminded of a time in history where you had two economists. They weren't really called economists at the time, but they were built on a philosophy of looking at how policies affect the outcomes of a nation. And in this case, we're talking about David Ricardo and Thomas Malthus. This was in regards at the time in 1815 when the corn laws were put in, a tariff to put in by Parliament to raise the tariff on imported wheat and protect the agrarian side of the farmers in Britain. Well, Malthus looked at it as a where there wasn't enough food going to be coming in because of the tariff, which you had a growing population, and we were going to have overpopulation without enough food to be able to support that population. Ricardo, on the other hand, looked at it as if you put a tariff on and you do price controls, then you're going to affect rents, which then if farmers go out of business, you're going to have less farms, and you're going to have that to not be able to supply the population. So you're looking at two different things, two different sides of the coin for the same outcome. How do you propose to get food at an affordable cost for a population to feed everybody? And it was looked at in two different ways, etc. Both of them were looking at it from the social science point. They weren't looking at it from the monetary side. And the reason I did this is because I ran across a story in regards to Manhattan. Manhattan apartment rents climb to summer highs as mortgage rates top 7%. Well, because inflation has hit and it has affected all types of real estate, especially commercial real estate and, of course, residential, if you raise the interest rates too high and the prices of those, whether it's a condo, whether it's an apartment building or the like, if they get too high that nobody can buy it and there's not an ongoing buying sell commerce within real estate, this is going to force people then to have to rent. And if not enough people are buying houses and they're having to demand and the number of renters goes up, well, it's going to, of course, cause rents to increase. So if you make it unaffordable to buy a house, you're going to soon make it unaffordable to rent a place. So you can see how choices made in one area can domino effect so many different areas, especially in that same sector. So that's why apologies there. That's why I was talking about the economics of it. Is one, you're stuffing 11 million people onto Manhattan Island every day during the work time, a small amount of people in a small location. When the workday is over, that island goes back to 2 million people. Many of the people live in the Bronx, they live in Queens, they live in, they travel to Connecticut, etc. But if we overpopulate an area where it is unaffordable to be able to sustain and either build enough housing or to have a modicum of rents where even the locals can't afford to do it, then are you going to have to then break up what Manhattan is and what Manhattan represents and have people move to different areas like Florida or the Midwest or the West Coast? So there's a lot of things when you take a look at it, and it affects the migration. We saw that in 2022. The policies made by California forced 800,000 people to migrate out of there because of choices in the government, and it affected the economics. They went from a surplus of budget to now being in the red by nearly $100 billion. Choices made at certain points have an effect across the board. And it's going to be interesting to see what Trump's economic policies are going to do when he's already been handed a bad hand of cards coming from the current administration, where we are at $36 trillion of debt, where we are already in a recession, we are already in stagflation. It's 1970s again, and we have a Fed chairman who doesn't have the cojones to do what's necessary. And of course, Trump doesn't want interest rates raised to umpteenth levels when he's trying to rebuild or make his legacy. So, a lot of things to take a look at. We're going to discuss those as they come about. And as always, want to thank everyone for being a part of the Sirius Report community and this discussion. Don't forget to like, subscribe, share, pass this on to anybody you think would be important. And until the next time we get together, have a great weekend.